tend to be so subjective? How have the Q factors evolved over the years to where they are today? The obstacles that our banking subscribers and all banks tend to face while using the Q factors as part of their allowance calculation. And then the meat and potatoes of today's session will be how Sageworks has been able to aggregate ALLL benchmarks, including Q factor data, what it is, where's the data come from, and how to justify using your Q factor adjustments to the regulators and auditors, et cetera. And then finally, Rob will take us through how to use that benchmarking information to its fullest potential. What are the qualitative factors? As I'm sure most of you are familiar, they are the environmental and qualitative factors used to reflect risk in the bank's portfolio that is not captured by the historical loss data. So in plain English, Rob, how do you tend to think about the Q factors?
Thanks, Jay. Really what these are meant to supplement your historic loss data. Keep in mind, when you're doing your Fast 5 calculations, you're trying to predict 1 year's worth of losses. In some cases, your historic loss data doesn't really capture that. You need to supplement that with your environmental and your qualitative factors.
Got it. Thank you. Let's go to the next slide. More than 50%. Now, this is from a poll that we did of our subscribers using our ALLL platform. This is the result. More than 50% of bankers say that supporting and calculating the qualitative factors is their biggest challenge in the ALLL process. What, Rob, why don't you shed some light? I mean, you talk to these guys every day.
Yeah, just from daily conversations, trainings, whatever. Frankly, I'm surprised that number isn't larger. I'm not too surprised, given that there's so little guidance from the regulators on Q factors. It's such a subjective process, and that's what a qualitative factor is. But it's just a lack of guidance, a lack of policy around it that just causes a lot of questions.
Gotcha. And I've had a good segue into why they are so subjective. Right? Obviously, the Q factors come from the 2006 Interagency Policy Statement, but that provides little direction. Right? The statement actually only advises that management should consider those current qualitative environmental factors that are likely to cause estimated credit losses as of the evaluation date to differ from the group's historical loss experience. So what do you see folks doing out there, Rob, to try to address that policy statement?
Really to try and put some bounds around it, try and put some sort of a framework around what they can. Usually to start off, many of these people wonder, if the percentage they assign is appropriate or not. Is it too much? Is it too little? They wonder if they're going to be questioned about it. So really to mitigate that, we're seeing more and more people kind of put sort of a matrix around that. So if a factor goes up or down, they apply a certain percentage to that. So we're seeing more and more of that to kind of minimize that subjectivity where possible.
I got you. And has that changed over the years, right? I mean, a couple of things that we've seen from an evolutionary standpoint is that years ago, it seemed like you could use the Q factors more as a plug or sort of a back solve, meaning I know where I want to end up with my reserve calculation, and I'm going to use the Q factors to get there. Since 2008, the Q factors have drawn much closer scrutiny from the regulators, who now view the adjustments as demonstrating how well a bank understands its portfolio, meaning they tend to be questioning them, digging in, scratching below the surface, peeling the onion, whatever cliche you want to use, to make sure that the bank is not sort of using the old school method and is actually using the Q factors appropriately. And lastly, oftentimes, and I think this actually bullet came from you, Rob. Why don't you speak a little?
Yeah, it's the first place regulators look when they're evaluating the ALLL. I mean, it's sort of ironic. I mean, you've got no guidance from the regulators, but it's the first place they look. It's the place that draws the most scrutiny. and it just causes concern for the banks. It's true.
And so some of the obstacles that creates to our audience, to bankers, is how do you limit that subjectivity? How do you document? Sort of, I think about my old high school math tests, where if I didn't show my work, I wouldn't get 100% credit. How do I get 100% credit? By justifying the assumptions, by providing proper documentation and defensibility, and demonstrating that directional consistency both within my own calculation and as it compares to trends in the industry or of my peer banks. Would you add anything else to that, Rob?
Yeah, I think the key thing when working with your qualitative factors is you want to document everything that you're doing, because what your qualitative factors are showing is the trends that are occurring in your portfolio. You need to supplement your qualitative factors, have the reporting, have the backup that's going to provide, again, the necessary backup to justify any percentages that you've applied in your Q factors, whether it's internal reporting, whether it's economic analysis, or any benchmarks. It's just critical that you provide your regulators and your auditors with that appropriate backup and comment where you can.
So why don't you keep rolling and discuss a little bit about how the benchmarks that we now can provide banks can help them?
Yeah, benchmarks, I think, are becoming more and more critical, especially as the data becomes available. I work daily with banks on their ALLL and even stress testing, and they're really anxious to kind of see how they are relative to their market. They want to see how they're doing relative to their peers. They want to see how they're doing relative to the market in general. And what benchmarks do is it's going to show them where they are at a point in time to see, okay, am I an outlier to my peers? Am I an outlier anywhere along the line? And we're seeing more and more need for that out there right now. They need to find a way to justify any of their qualifications, their Q factors, if you will, and benchmarks help with that because it's actual real data.
Got it. So the different types of benchmarks that we both have seen typically available to bankers, as well as the newest resource for defensible benchmarks, are one, of course, just talking to your peers, talking to consultants, talking to industry experts to sort of do your own survey. Obviously, that remains somewhat subjective and tough to document and defend. There is data from peer call reports, so obviously from the call report data that's available, banks are able to sort of cut and paste together their own calculations and documentation of what their peer banks are doing. And then lastly, and most recently, of course, are the ALLL benchmarks available in Sageworks Bank Information. So the Bank Information platform is a way for Sageworks to give you the ability to get data out of our system that we've collected and aggregated from our subscribers in an anonymous basis. All right, so from call report data, you can get information that might look something like this: various ratios and benchmarks, your allowance to total loans, allowance to non-performing loans, things of that nature. But how do you get things like qualitative risk factor adjustment percentages? And that is where the Bank Information Program can help you. So with our several hundred subscribers that log in and manage their allowance calculation within the Sageworks ALLL platform, we're going to see how those adjustments, both FAS 5 calculations, FAS 114 calculations, and Q factor adjustments can be aggregated and reported back to you through the Bank Information platform. So we're going to go now to the live Bank Information platform and show you exactly how it works. So give me 1 second while I get there. and get back going, and you should now see a screen of the Sageworks bank information platform, and we are logged into the ALLL benchmarks and able to see a breakdown along the left-hand axis, percent of loan portfolio as FAS 5s, and on the right-hand axis, percent of loan portfolio as 114, and across the bottom axis, we're looking at quarterly reporting data.
Yeah, this is great information. This is a very useful tool I think that banks can use as far as justifying both their FAS 5 and their FAS 114 calculations. It lets them see sort of the trends that are developing in the market, in the economy in general.
So this, if we look at the actual data down below, we can see the actual change in percentage by quarter for FAS 5 and 114s. We can also see the total number of banks reporting to us through their use of the ALLL calculation, and we can actually even get a glimpse. Obviously, we only have about 102 banks so far in Q4 that are starting to work on it. That will fill in, and you can see the trend in increasing number of banks as we continue to subscribe more and more banks that are reporting. Now, because we're getting down to the Q level factors, what bank information can enable you to do is to either isolate the FAS 114s or FAS 5s or actually select the qualitative adjustment factors. If I wanted to look at the trend in Q factors for a particular region of the country, I could select a particular region. If I wanted to look at specific call codes, for example, recently there's been a lot of activity in our secured non-res properties. So let's first look at loan secured by owner-occupied non-farm non-res properties. So I can select by call code. If I wanted to look at banks in similar asset ranges as whatever my institution was, I can do that. If I wanted to sort by charter, I could select that. And then I have the choice of looking at either trends or a bar chart. So let's start with the trend chart. Again, this is going to be for our Q factor adjustments for 1E1 call code. I click go. The program's going to crunch through and now show me for each of the 9 different Q factors, as I scroll down here, the historic trends.
Jay, and this is great because one of the key things when you want to consider with Q factors are the trends that have been developing within the particular Q factor. It gets you toward that idea what they call directional consistency. Each Q factor needs to be in line with the metric that it's analyzing. So this is actually going to help banks see the trends that are occurring, whether it's their region, their charter, or whatever. A very good tool for that.
And if I click the expand button on any of the Q factors, I can open it up and see how many of the banks from which we're aggregating this data are utilizing this Q factor. And again, I can see that trend. Obviously, we've dropped off because we don't have everybody reporting for Q4 this year yet, but we can see that directional consistency in the decrease in changes in international, national, regional, and local conditions. For any of these charts, I also always have the ability to save this data. So when we talk about being able to document and defend my Q factors in relation to these benchmarks, I can always provide that documentation in hard copy or electronic file as well. What if we take this same assessment, but instead of 1E1s, we look at 1E2s? So secured loans, and I click go. Do we think there's going to be any change?
And remember, this is the investor properties here, so yeah, a little bit of a change there.
Right.
I think in general, I think we're all seeing a lot more pickup in commercial real estate activity. So in addition to providing maybe benchmarks for ALLL, this could provide benchmarks from a portfolio management standpoint. Let sort of people know where, credit quality looks like for your, your 1E1s and your 1E2s, both your investor and your owner occupied.
And of course, if I want to see it in bar chart form and document that as well, I can always toggle and look at the data as well as the graphical depiction to be able to save that, print it out, and include in my documentation. So now let's go back to the presentation. And move on to the uses of this benchmarking data now available in bank information and how Rob believes it can be best utilized.
I think this is a great tool to supplement your existing internal documentation that you're using for your Q factors. It really is just going to support your decisions. It's going to show that you're going to be maybe in line, your results are going to be in line maybe with what the particular metric is. It's also going to show you where you may be an outlier to your peers. But it's going to give you the chance to go ahead and explain in maybe greater detail your ALLL, your Fast Fives in general, and even from a portfolio management standpoint. This is real critical to supplement your information during exams. It's great for board presentations. Boards are always really asking, okay, where are we relative to our peers? You're going to be able to show them where you are relative to your peers, whether you're in line or whether you're out of line. And if you're out of line, it's going to give you a place to say, okay, well, here's why we're out of line, to maybe present some additional information regarding that. And again, from a peer management, a portfolio management tool, again, it's going to be very crucial to see, okay, how's my commercial real estate pool doing relative to my peers? How everything else is doing, again, relative to your peers.
Right. Because, the purpose of today is not to dive into bank information more, but there is all of the call report data, et cetera, built into bank information so that you can build a lot more reports and analyses if you chose to have access to it. So with that, I believe Jackie is now going to ask a poll question. Is that right, Jackie?
Yes, absolutely. Just wanted to take 1 minute. I know we're keeping this presentation to total 25 minutes or so. So I know Jay, you and Rob took the opportunity to go ahead and show a little bit about Sageworks Bank information, but we only have so much time. So I insert a poll here that just asks whether you'd like to learn more about ALLL benchmarks. And if you would like more information, just feel free to enter yes. If not, no worries. Just thought it'd be a good opportunity to see, if there were further questions that we could answer then offline. So I'm just going to leave it up for maybe a few more seconds or so. And thank you to everyone. Looks like there's a good amount of participation here, so really appreciate it. Okay.
Okay. Well, looks like we've got a couple questions popping up here. So let's go ahead and field a couple in the last minute or two. The first one is it better to choose a peer group by size, by regulatory body, or by portfolio makeup?
Jay, that's a great question. I get asked that actually quite frequently. If I'm going to probably have to pick one of the three, I'm going to have to say by portfolio makeup. You want to kind of keep your peers relative to maybe your risk appetite, your product mix. You want to kind of measure yourself against similar organizations, not necessarily by regulating body or by size, although that may work for you. But I think you generally want to keep your peers relative to how you look at your own business. They could be by the same size, but don't let size limit you. Keep it to portfolio makeup or by risk appetite.
Gotcha, gotcha. Okay, here's another one. This might actually be our last one. Are there other common qualitative factors used by banks outside of the 9 typical ones you listed?
Yeah, I'll say sort of the trend with the customers that I've been working with is we are seeing more risk factors being used. And it's for a variety of reasons, but in general it's to maybe isolate unique factors within the portfolio. let's just say that there's maybe a new product coming on board or some sort of unique product factor that they can't really quantify. They'll add a new risk factor to kind of put a number on it. Maybe they're getting into a new market or a new region. There's some unknown factor out there related to the portfolio, the market, or whatever it is. So they'll create a new risk factor to account for that.
I got you. And that actually brings up another sort of question that I know people are asking themselves, even though it hasn't popped up, and that is when you look at the trend in the number of banks who are contributing to those ALLL benchmarks, we've got many more subscribers that are listed, but only the 9 standard Q factors that we can report on consistently are available. So if folks are using their own custom factors, obviously we're not going to aggregate and report on those. So that really brings us to closing time. Thank you, Rob, for helping out here. Thank you, everyone, for participating today. And Jackie, any closing comments?
Just if anybody has any further questions, feel free to contact Jay or Rob directly using the contact information on the screen. There's also a link to the bank information website if you wanted to explore around there. And just finally, I will be sending out a recording of the webinar as well as the slides to everyone via email. So if you have any questions directly for me, my name is Jackie Drum. Feel free to respond directly to me. And for those of you who did want further information on ALLL benchmarks, we'll follow up with you with that as well. So thank you all very much. Hope everybody has a great afternoon, and we look forward to hopefully speaking with you all again soon.